Hello and welcome to the Golden Thumb Rule, where we break down the core principles that truly matter in long-term investing. Well, investors are constantly being bombarded with, sector buzz, thematic narratives, and market cycle headlines. Technology one year, manufacturing the next, small caps in bull market, large caps during uncertainty, and somewhere in the middle, investors struggle to stay consistent. Well, to help us break down, we have with us someone who has navigated markets for decades with a disciplined, fundamental first investment framework. And he's George Heber Joseph, who's a CEO and CIO equity at ASK Investment Managers. George, thank you for joining us.
Thank you. Thank you for having me here, Kshitij.
Let's just quickly start with the first thumb rule, you could say that. But, if there were just one thumb rule for long-term wealth building, would you say it's asset allocation? And why does spreading money across equity, debt, and gold matter more than chasing returns?
So one thumb rule, definitely, I would say, as a first thumb rule for investing is, proper asset allocation. When you invest, when you understand the risk of each asset class and the valuation differential and attractiveness, and it becomes very interesting, how much in which asset class you want to allocate. That's what I have learned over the last 35 years. When we look at the investing history, from my own perspective, the asset allocation has given the maximum amount of returns.
How does sort of a proper asset allocation act as a cushion during the market volatility or economic slowdowns? You could say that.
Equities, in principle, if you have looked at it, nominal GDP growth in India has been phenomenal. 11 to 12% growth in the next decade also is reasonably possible, looking at the construct. From that perspective, allocating into equities always have delivered good returns for the investors, but it comes with a lot of volatility. To manage the volatility, you need to have some balancing act in your portfolio. That's a gold, you cannot value gold per se, because there is no price to earnings multiple or any valuation metrics you can value gold. But gold, that it is a safe haven status. And whenever the entire world is going down, gold is the one asset class which can potentially, safeguard your portfolio. So ultimately, say, for example, if you invest 100 rupees into one asset class and the asset class falls by 50%, right? To get back to where you were, you need to have 100% return, right? So it is not easier. It is easier said than done. That's where you need to create a balancing act in your portfolio, that one asset class goes down significantly, something else protect your portfolio. If you do some bit of homework, it is possible to identify which are the asset classes where you need to be overweight, which you need to be underweight, and that becomes an important pillar in investment decision.
Apart from that, my next question is very interesting, and in fact, a lot of our viewers would want to know more about it, and that is related to the small and the mid caps. So, many investors either love small caps or stick only to large caps. What's the golden thumb rule when it comes to allocating across large, mid, and small cap segments?
Most of the time, people don't look at history, right? You are mostly imbibed in the recency effect. What has happened in the market in the recent times, which IPO has done well, which stock has done well, and so on and so forth. If you just take a step back and see, what has happened in all the IPOs in the last 5 years. Right. Many IPOs are underwater by 65%, 70%, which has oversubscribed by 300 times, right? So, so the hype is one part of it, and where ultimately you make money is another side of it. My thumb rule, which I tell my daughters also is, look, when you see a massive crash in the market, right? A crash is in the sense, I would say 25% above fall in the market.
Okay.
Right. That's where, you need to be very enthusiastic about, small caps and mid caps. You keep the money in your bank account or keep investing in large caps, and suddenly you see a massive sell-off. And that's when, you need to be adventurous and say that, okay, 25% plus fall in the market, which is unusual. Right. Like COVID, for example, market fell by 40%. Nifty fell by 40%, right? Or global financial crisis, market fell by 67%. So whenever you see those kind of events, look at the sectors which has not done well for the past 10 years. and go into the small caps of those sectors.
Okay.
Right. So that is one thumb rule I would say as a retail investor you should keep in mind.
Absolutely. And in fact, my next question is on the balancing act again. And George, if you can explain how market cap diversification help balance, growth potential and stability. Yes, in the earlier question, you did point out that, if someone is looking to buy into small and mid caps, look for a 20% or 25% plus kind of a drawdown that happened. And yes, you can probably, increase your allocation. So let's say, for example, if nothing of sort that has happened, but still, we are seeing sort of a increasing interest in the small and mid cap space as well at this point in time.
So from a money making perspective, we discussed about asset allocation first. Sure. The second part is the market cap allocation. So which market cap is looking attractive? Sure. That is very important because at different points in time, different market cap segment looks attractive. You need to understand the relative valuation dynamics, relative growth dynamics of these segments. Today, for example, in 2 decades, small caps and mid caps is trading at one of the highest valuation point, right? So this kind of situation, whereas in 2013, it was one of the cheapest point. Now, when 2013, if you look back, it was not an easy environment, right? Markets were going through a tough time. There was a twin deficits, all kinds of issues. So a hell lot of chaos. And that's where the small and mid caps became very cheap. Today, we are very bullish on the large cap or Nifty 50 stocks. What ideally you should do is, that, as I mentioned, the allocation you need to pump up in small caps and mid caps only when you see a massive drawdown. Sure. Otherwise, you keep investing into large caps and, you will be quite well off even then.
Sectors and themes change with every economic cycle. And what thumb rule should investors follow to identify opportunities without getting trapped in hype-driven trends?
Looking at the noise, looking at the TV channels, and you looking at, you will not be able to get a head or tail of it, right? So what you need to do is, as I mentioned, earlier, look at from a bit long-term perspective. It is not a one-day game. Right, it's not a T20 or it's not even a test cricket, right? So it is not going to end in few days. It is a long-term journey that every investor has to go through. That's when the compounding effect happens. If I divide this 35 years into 4 buckets, right? So 1990 to 2000, post-liberalization, we saw a massive boom in the technology, media, telecom stocks.
Okay.
Right, and that was the biggest winners in those decades. And then you saw a massive drawdown. And then eventually you saw the tech bubble or the dot-com bubble hitting in 2000, right? And it bursted. It went up like crazy and then it bursted. Probably, we are bracing in for an AI bubble. Post that, you saw the decade was of infrastructure boom. Then you saw global financial crisis hitting in 2008, right? And post that, there was a bounce back. But again, the sectors which emerged as winners in the next decade were consumer-facing businesses. Okay. Then 2020, COVID crash. Then the sectors which emerged as winners post that were not the consumer-facing businesses, and they slowed down big time. And you saw the sectors which emerged are again the infrastructure, capital goods, real estate, and PSU banks. So to me, these decadal cycles are very easy to look at and very easy to project. We were in 2020 after the crash, what you would have done is that, you look at the sectors which has not done well for the previous 10 years and, start nibbling those names. And that has become as a massive winner. Now, last 5 years, commodities were the biggest winners in the market, which nobody would have thought in 2020. And if you are good at looking at the numbers, then it's easier to capture these things.
Absolutely. I think, in fact, you did point out that if you're good at looking at numbers, in fact, my next question is also related to that. So when evaluating companies, what is the one enduring thumb rule investors should always remember?
Many times, I feel that the way people are investing, they're financially blind. Okay. Right. So you're not looking at the valuations, you're not looking at the sensible things, right, and you're not questioning yourself before putting your hard-earned money. So the thumb rule, which I would say is, don't overpay for any business you are buying or any stock you're buying. or the same asset class what you're investing in, don't overpay for any asset class.
Sure.
Don't overpay for a segment of the market. My thumb rule is don't overpay. If you do that, you will be well off majority of the time.
All right, let's move on to my next question. Markets are cyclical, and investors' emotions aren't. So, what thumb rule helps investors avoid emotional decision making?
To me, it is highly emotional and sentiment driven decision making. That's where fund managers like us, we need to be cutting across the noise and think differently and think against the crowd to make money, right? So if everyone is selling, that's an opportunity to buy. When everyone is buying, that might be the opportunity to sell. Right. So I remember the conversation with Mr. Warren Buffett. People asked him, how did you make so much of wealth? Mm-hmm. Said that when in my last 6 years of investing, I've seen big 6 booms and 6 busts. I have been sane enough to sell into the booms and buy into the busts.
And in fact, my last question is very similar to the one I've asked, but in a very layman's term, just like you said, avoid the noise. So if someone is just starting their journey today, what is your single golden thumb rule they should follow, no matter the market, what news cycle is going on or the trend? How should one look at that?
Having different asset classes, investments in right proportion is something which every investor should aim for. And you need to keep for contingencies, because if you invest in real estate, it is not easy to take out money. When you invest in equity, at least you should keep a 5-year plus view. If you're investing in fixed income, probably you can have lesser horizon as your view, depending upon the segments of fixed income you're investing. So you need to keep a long horizon for compounding to kick in. Sure. Invest balanced way. So thumb rule is invest in across asset classes, have some proportion, right proportion. You have some thumb rule in which you allocate into these asset classes.
Absolutely. Well, on that note, George, thank you so much for sharing these insights. Clear, actionable, and very timely. And to our listeners, remember, market changes, cycles change, but discipline and clarity are what that builds the wealth for an individual. Thank you so much for taking the time out, George.
Thank you, Kshitij. It's a pleasure talking to you.